The gas bill on the table has doubled. The mortgage rate just reset. Groceries quietly eat a third of the paycheck. On the other side of town, a portfolio update arrives. Higher dividends, rising asset values, a new subsidy package secured. Same crisis, different outcome. This is the invisible contract. Gains are privatized, losses are socialized, and the middle class acts as the shock absorber. From 2008 to COVID to Europe's energy crunch, the pattern repeats. How did we build a system where some are insured by design, while others are permanently exposed? For a brief period after World War II, Western economies tried to balance markets with social stability. Germany called it the social market economy. Competitive firms, but strong unions, wage growth tied to productivity, affordable energy, and expanding welfare systems. The deal was simple. If you worked, you could build a life. Own a home, raise a family, save for retirement. Crisis was an exception, not a permanent background condition. From the late 1970s and 1980s onward, that settlement began to unravel. Inflation shocks, oil crises, and slowing growth triggered a policy turn. Deregulation, privatization, and liberalization were the new answers. Finance moved to the center of the system. Capital controls were dismantled, cross-border flows exploded, and the banking sector grew far faster than the real economy it was supposed to serve. The silent change wasn't just ideological, it was institutional. Central banks were made independent, focused narrowly on inflation, and gradually discovered a second mission: stabilizing markets whenever volatility threatened systemic players. Interest rates drifted lower over decades. Each downturn was met with cheaper money and more liquidity. The result was an economy where those who owned assets rode an almost continuous wave of inflation in stocks, bonds, and real estate, while wages stagnated. In this world, risk didn't disappear. It was repackaged. Complex financial products, securitized loans, and derivatives allowed institutions to chase yield under the assumption that, in the end, liquidity would always be provided. Too big to fail wasn't a phrase from 2008. It was the logic of the whole structure. Certain banks, insurers, and industrial champions became system critical. Their survival wasn't a bet. It was guaranteed policy. When the global financial crisis hit in 2008, that implicit guarantee became visible. Governments and central banks moved at scale. Capital injections, guarantees, emergency lending, asset purchase programs. Balance sheets at the top were stabilized. The cost, through austerity, reduced public investment, and long-term debt, was pushed downwards. Households faced job insecurity, wage pressure, and cuts to services, even as the financial sector recovered quickly. The important point is not that there was one bailout. It's that a pattern was established. Crisis became part of the business cycle, and policy became predictable for those positioned correctly. If you were large, leveraged, and connected enough, the downside was limited. If you were small, local, and dependent on wages, you absorbed the volatility. After 2008, the same tools were used again and again. The Eurozone debt crisis saw central banks backstop sovereign bonds, while populations endured internal devaluation and unemployment. COVID brought direct support to households, but again, asset markets were rescued first and most aggressively. Ultra-low rates and massive injections of liquidity drove housing and equity prices to new peaks, widening the gap between those who already owned and those trying to enter. In this context, crisis management turned into a recurring business model. Volatility created opportunities, distressed asset purchases, consolidation, new rounds of subsidy negotiation. Large players learned that aggressive risk-taking could be rewarded twice, first in boom times, then during rescue operations. This is the core of moral hazard at the top of the system. The hierarchy of protection hardened. At the top sat globally active banks, multinationals, and investors whose potential failure threatened the architecture itself. Below them were large domestic firms and key infrastructure providers, important enough to secure special deals. At the bottom were ordinary workers, small businesses, and municipalities, operating without guarantees, managing rising costs with no direct line into the rescue machinery. The real question is, once crisis becomes routine and rescue becomes predictable, who is the system really designed to protect? If crisis is now a recurring feature of the system, the obvious question is, how do some people keep coming out ahead? The answer isn't luck or individual genius. It's an architecture. A set of mechanisms that quietly ensure those at the top, while leaving everyone else